Hello and welcome to today's episode of Modesty's Mortgage Masterclass. This is session number 14. And today we are going to be talking about um, types of mortgage borrowers. This is part 5 on this series, and today we're going to be discussing business borrowers as a type of mortgage borrower. So for the past 5 weeks, we have been discussing the different types of mortgage borrowers. Okay, so welcome aboard to session number 14 of Modesty's Mortgage Masterclass, where every Wednesday we gather here and we educate ourselves on the latest on mortgages, update our knowledge on what we know about mortgages, and acquire new knowledge. And as usual, I'm going to be bringing you updates on what is happening or what has been happening in the mortgage market, in the housing market, in the mortgage world. For those of you who already have mortgages, this is very useful to you. And for those of you who are aspiring to buy properties using mortgages, this is equally important and crucial to you. So today we are going to be continuing on the series of types of borrowers, and we're going to be discussing business borrowers today. You know, how they are perceived and how they are assessed and how they are treated by lenders and what actually or who actually are business borrowers. But before that, let us see what's been making rounds in the mortgage world. So now the latest news or the biggest news so far is the statistics that was released by Nationwide recently. Nationwide released the statistics on house prices, and shockingly, but not unexpectedly anyway, house prices have recorded the biggest monthly drop in 11 years. Since 2009, there has not been this much drop in house prices on a month by month basis. So basically the average house price in the UK dropped by 1.7% between April and May. Okay, that's the latest information from Nationwide. 1.7% drop. Now that is massive for those who know a thing or two about house prices. But hey, before you start jumping out of your sofa and screaming your head off, and then thinking that well the value of your property has been eroded or erased. Now let's look at that information in more detail. So this information is an indication of what happened to house prices as a result of the lockdown. Okay, now breaking that down further, the average, according to the chief economist for Nationwide, Robert Gardner, he basically said that this is simply the effect that the lockdown had on house prices because of the lockdown there was practically little or no activity at all going on in the housing market. Very few houses were sold, very few houses were viewed, very few mortgages were taken out. So the property market was practically dead as a result of the lockdown. Prior to the lockdown, the housing market was picking up nicely. The housing market was doing very well. But the moment the lockdown came in, people couldn't view properties anymore. Mortgage products were withdrawn. People could not do surveys. Some sales were withheld as well, and just so that things can come back to a little bit of normal. So, and because of this, the HMRC recorded a 53% drop in residential house sales between compared to April last year. Okay, the HMRC recorded a 53% drop in residential sales compared to April 2019. So now, while the statistics from the Office of National Statistics and from the Rightmove have been suspended because of the scanty nature of the data that they have, Nationwide, on the other hand, thinks that they have enough data to release this information. Yeah, that they have enough data, but Office of National Statistics and Rightmove, they've suspended, any information or any statistics relating to house prices and house price guide, because as far as they are concerned, there hasn't been enough listings or enough activity in the market to justify whatever statistics they're going to come up with. The nationwide felt that they have enough data to do that, and that's why they have come out with this. So the transaction levels were very, very low because of the lockdown. That's exactly why you are seeing this much drop in house prices. Because to be honest with you, if you have few transactions going on, where you aggregate those few transactions and you compare that with what you had, between this time last year and this period, obviously there will be there'll be a significant drop. But on month by month basis, since 2009, this has been the biggest. That's about 11% drop in house prices. By 1.7% drop on monthly basis, and that has been the worst for 11 years. Okay, now before you start screaming blue mother, yeah, calm down. This does not really say anything or imply anything. The only statement it makes here is that the lockdown has had impact on property activities. And this result, according to a lot of experts, simply is an effect of the lockdown on the property market. It does not really reflect the sentiments and the reality of the property market since the lockdown was eased. Okay, so what it meant was that this is the first major data that has come out since after the lockdown was eased. And because of the lockdown, scanty nature of the activities that happened in the property market warranted this drop. So it wasn't surprising that it happened. In fact, it would have been more surprising if it didn't happen, if there wasn't this drop. So it's simply a result of the lockdown. It's not an indication of what the property market is looking like presently. Then a lot of people will be asking the question, so what then happens to the property market? Now, from according to professional views and what we are seeing on ground, with the properties, since easing the lockdown, there has been increase in viewings, there has been increase in inquiries, there has been increase in property sales, there has been increase in general property activities. Although the medium term outlook for properties market still looks a little bit uncertain, but in the long run or the long term, it doesn't look that gloomy. The reason being that the property market is part of the wider UK economy. And then if you look at what the government is doing and all the money they are pumping into the UK economy, those monies they are pumping into the UK economy because of this pandemic will eventually come around to help the economy to cushion the effects of the lockdown. Policies like, the bounce back business loans that have been advanced to business customers of all the banks in the UK who are approved for that. They can, the business customers can get up to £50,000, loan. That's very, very cheap loan for them to kickstart their businesses. The government has been offering support to furloughed workers, paying 80% of their wages, and in some cases, their employers have been paying the remaining 20% while they're on lockdown and they can't work. The government has, pumped in over over 200 billion pounds into quantitative easing, which is basically just printing money and pumping it into the economy. And they have reduced the base rate to 0.1%. So mortgages are very affordable now. Lending is very affordable now, encouraging the banks to lend. There have been self-employed support as well to the self-employed that they are receiving. There are supports available for big businesses, where they get the coronavirus intervention loans. So all this money is being pumped, over 300 billion pounds being pumped into the economy by the government. This is to cushion the effects of the lockdown on the economy. and the property market is part of the wider economy. So the expectation is that the property market will benefit from these government interventions. And therefore, the outlook, the long-term outlook for the property market is not looking bad at all. Because at the moment, people who are not going to work but are furloughed, they're actually seeing that there is more money in their account because they don't commit to work. All the usual expenditure they used to engage, they used to engage in, like eating out and all that. They don't go out anymore. They don't eat out. They don't go to the cinemas anymore as often as they used to do. They don't go shopping all the time anymore, except for essential shopping. So although they still shop online, but they don't spend as much money as they used to spend when they used to go to work, but they still get paid. So that's kind of gives consumers confidence. Yeah, they still feel good at the moment. So there isn't that kicking out by everyone in the economy in the country thinking that things are going pear shaped. But at the moment, everybody is calm because the government is doing a lot to soften the impact of this. So in terms of the properties or the property market, it will benefit from this stimulus by the government. So although now there are calls for more stimulus packages specifically targeted at the property market by the government, if they could, for example, like a stamp duty payment holiday, like waiving the stamp duty for a while just to kickstart the property market again. So these calls, if the government heeds to that, will also help the property market to bounce back a lot quicker than expected. Okay, so the recovery of the market will not be automatic, but it will be gradual. So just in case you're sitting thinking, oh, you're rubbing your palms, but the property prices are dropping, they're dropping like flies. So I'm just gonna hold on and wait until it drops flat. If you are waiting for a crash in the property market, sorry, I don't think it's gonna happen. This is just a temporary effect of the lockdown. And what we are seeing and feeling in the property market at this point in time is that there is still shortage of supply. And as long as there is shortage of supply, there will be no crash because sellers are not really desperate to sell. Yeah, they want to sell, but they're not desperate to like drop their prices to the point where it becomes hurting for them. Or if you're a potential seller and you're thinking, oh, it's not a very good time to bring my property to the market because prices are dropping. No, it's just the effect of the lockdown on the property market. And with time, these things are going to even themselves out, and the stimulus and the intervention from the government is going to have a wider effect, a macro effect on the economy, which is going to help the economy to bounce back a lot quicker than we expect. Okay. Then the other thing that has been making the rounds in the mortgage market is the unfortunate situation of people who are depositing 5% for their mortgage. So the 5% depositors, especially, which is mostly the first-time buyers. What we are finding in the market is that there are fewer and fewer options, mortgage products available for them in the market. Not too many lenders are keen to lend on 95% loan to value at the moment. So we have seen a drop in the number of 95% loan to value mortgage products available in the market. In the last month, between May and June, the 2-year fixed 95% loan to value mortgages have dropped from 11 to 5, just like 5 products like that in the market, and the 5-year fix have dropped from 11 to 9. So it's been dropping steadily since the pandemic, and this is the latest drop again in the availability of 95% loan to value mortgage products. But however, the 90% loan to value products is increasing. So we have more 90% loan to value products coming on the market than the 95% loan to value products. So we have seen an increase between May and June of 2-year fixed products of 90% loan to value jumped from 24 to 55, and the 5-year fixed products for 90% loan to value have jumped from 26 to 51. So more and more 90% loan to value products are coming on the market as against the 95% loan to value products. So the average rate across the board for 95% loan to value, for example, 2-year fixed mortgage product for 95%, the average rates we are seeing across the board in the market is between 3.36, which was what it used to be last month, but it's dropped to 3.28. Okay, and then for 5-year fixes for 95% loan to value, the average rate has dropped from 3.62 to 3.48. So even though the number of products are reducing, we are seeing a drop in the average rate for these products, for 2-year fixed and 5-year fixed products. But it becomes a lot different the moment you can double your deposits. So if you can double your deposit from 5% to 10%, all of a sudden the picture becomes a lot different. So it becomes a lot better, because what we are seeing is that for 90% loan to value mortgage product in the market, the 2-year fixed products, the average is falling from 2.4 to 2.3. And then for 5-year fixed, it's falling from 2.65 to about 2.57. So you can see the difference. The 2.8 for 2-year fixed for 95%. Sorry, 3.28 for 2-year fixed for 95%, and then 2.3 for 2-year fixed for 90%. So you can see what the difference is between the 90% and 95%. That's where the lenders' appetite lie at the moment. Their appetite is not so much in the 95% loan to value. The appetite is so much on 90% loan to value. That looks like it's going to be the new normal for some time. The reason being that lenders are not too keen to get onto higher loan to value lending just at the moment because of shortage in operational capacity for the lenders. A lot of their workers are working from home, and they are really keen. They are more keen on supporting their current and existing customers, some of whom are requesting for mortgage holidays and ways to support them through this pandemic. And to service their existing customers is of paramount importance to them than just taking on massive influx of 95% loan to value, which is basically a higher risk exposure for them. But for 90% loan to value, yeah, they can at least take on that, because to them it's a lower risk exposure and they can afford to take on more businesses in that category. So it doesn't bode well at the moment for first-time buyers. But then, if as a first-time buyer, you can find a way of upping your deposits from 5% to 10%, you find yourself a lot better deals, because there are more products available for you in that respect. But if you can't find any product that fits at the moment, and you haven't got the level of deposits that will give you that much better deal, you might just have to wait a little bit longer, and then more products could still come to the market. The lenders are, they want to get back to lending to like 95% loan to value, but at the moment they just can't do that because of these constraints, that they are facing at the moment. Okay, so the other thing that caught our attention is part of what we discussed last week. We talked about the mortgage payment holidays. So the FCA have confirmed their support for the mortgage holiday extension. So anyone who wants to take a mortgage holiday can do that from now till 31st of October 2020 if you haven't done that already. For those who already have the mortgage holiday set up, if yours is coming to an end, the advice is speak to your lender. And if extending the mortgage holiday is a good option, a better option for you, and you really need it, then you can take it. But discuss other options available for you with the lender. There might be better options for you than just extending the mortgage holiday. And like I said last week, don't take the mortgage holiday unless you really, really need it. Because taking the mortgage holiday in the long run doesn't really favor you that much. You'll be better off if you can afford to pay your mortgage or at least some part of it. You're better off doing that. Okay, because what it does is that you just keep reducing your interest and it helps you pay your mortgage off quicker and reduces your debt. So the longer you leave the debt and the amount up and the build up, the more interest it's accumulating and then the more debt you're going to be owing. And that's been the standard advice across board from all the experts who are involved in mortgages and property. They all, even the FCA, the government, the lenders, and everybody, they're advising if you can afford to pay your mortgage, pay your mortgage. Yeah, it works better for you in the long run. So because mortgage holiday is not free money, we keep saying it. It's not. If you think it's free money, it's not, because that is money you still have to pay. That's the debt that you still have to pay to the bank later on. You're just putting it off for 3 months. That's all you're doing. And as you put it off, it keeps on accumulating interest. And in the end, you end up paying more than you should have paid. So if you can, please, if you can avoid it, avoid it. But if you can't, if it's inevitable, take it as an option. Also, the FCA have also confirmed that, all repossessions will be put on hold until 31st of October 2020. So no repossession of any properties will happen within this 3 months extension of the payment holiday as well, right? And then, as we also mentioned, the mortgage holiday will not have effect on your credit file, right? That has been agreed by the lenders. But then, don't forget that lenders can make their decision based on other information available to them. Just in case you're looking to borrow again, they can look at your bank statements and see, how much of your credit commitments you've been servicing and all that. They can make their decision based on things like that. So it may appear like it's not appearing on your credit file, but lenders are asking that question when you come to borrow. They will ask whether you have taken a payment holiday. Whatever they want to do with that information is up to them, and we do not know. So for those who have already taken out their payment holidays, if you want to extend it, talk to your lender. If you don't want to extend it, you can afford to paying down your mortgage a little bit, fine. But up to date, about 14% of the borrowers in the UK have taken a payment holiday. About 14% of mortgage borrowers in the UK have actually taken this payment holiday. Okay, now let's dive straight into today's topic. We're talking about business borrowers. Okay. If an individual takes out a mortgage or a loan for business purposes, and that loan is secured on a property, yeah, what makes that loan a regulated loan or non-regulated loan depends on the property that loan is secured against. Now, if that loan is secured against a property that at least 40% of that land, 40% of the land on which the property sits, the emphasis on the land, not just the house. If at least 40% of the land on which that property sits is used for residential purposes, then that mortgage is a regulated mortgage. So if you take out a loan and you're taking it for business purposes, and the property on which that loan is secured as a mortgage is the land on which that property sits, if 40% of it is used for residential purposes, that is classified as a regulated mortgage. Now, the difference between regulated mortgages and non-regulated mortgages is that for regulated mortgages, your consumer rights are protected. You have a right to complain against the advisor or the lender if you feel they did not give you the product that was adequate for your circumstances, yeah, and all that. So you have that consumer right, you have that right to complain because they are supposed to act in your best interest. So if they did not act in your best interest, you can go to the financial ombudsman and make complaints. For non-regulated mortgages, it simply means you have waived that right. It means that it's assumed that it's pure business decision which you took based on the fact that you have done your due diligence, you have done your homework, you have done your analysis, and you feel this is right for you. And if anything goes wrong, you cannot go to the financial ombudsman to make complaints, and you do not have the right The consumer rights have been waived because it's purely a business decision. So if an individual takes out a loan secured against their house or a property, and 40% of that property is for residential, that is your own individual's residential purpose, then it's a regulated mortgage. You've got some protection rights. You've got some consumer rights. You've got rights to complain. Yeah, the FCA regulates that mortgage. Okay. Now, this is one condition that defines whether a mortgage is regulated or not. The second condition that determines that is if the sole purpose of the borrowing to raise the funds is for a small business purpose. Small businesses are businesses that their turnover is less than £1 million, right? Maybe, and it's not an LLP or is a limited company. So these are the two conditions that determines whether a loan or mortgage is regulated if it's for business purposes. Yeah. So if it meets these two conditions, then it's a regulated mortgage. One, if it's solely for business purposes, for small businesses with turnover of less than £1 million. If the security, secondly, if the security on which it is secured and 40% of that land is used for residential purposes, then it's a regulated mortgage. So if the mortgage is taken out by a business, say an LLP is a limited liability partnership or a limited company, or by individuals in the business, yeah, and if it is secured against a business premise, then it's an unregulated mortgage. Okay, so the lender must see an evidence, yeah, the lender must see an evidence to prove, that loan is for business purpose, yeah, and that the business can support the payment of that loan. And they will see such evidence like a business plan to see where that money will be invested. So if that loan is taken out by an individual who is in a business, right? Or if the loan is taken out by the business itself, which is like a limited company or a limited liability partnership, it becomes an unregulated mortgage. Yeah, and I have described what unregulated mortgage is and how it differs from regulated mortgages. And then the lender will now carry out their affordability checks based on the income and the expenditures of the borrower and the other liabilities that the borrower has and the other affordability criteria that they deem fit. When the lender concludes on this affordability checks, the lender can now make a lending decision based on the outcome of those affordability checks. Now, if the repayment of that mortgage is to be made from the resources of that business, the lender will also consider the strength of those resources. The business assets, the income that it generates, if the business has savings, everything that the business owns, the resources that will fund the repayment of that mortgage, the lender will take into consideration all of it, right, before they make that decision, just to see how robust that application is and what the financial strength and standing of that business is prior to them lending that money. So the underwriting process will take all that into consideration. But if the borrower happens to rely on the business for their income and their expenditure and their personal lifestyle, and then the lender will now have to also consider, can that business support the borrower at the same time repay this mortgage? All these numbers have to add up for the lender to decide whether to lend to that business or not. Okay, so now let us look at different forms of businesses that can actually borrow money and that can present themselves as business borrowers. We've mentioned partnership, but there are different forms of partnership that I want to specify now. Number one is business partnerships. Now, business partnership is simply an arrangement between self-employed people to run a business or to work together. Unlike a company, it's not a separate legal entity, so it's not separate from its owners. Business partnerships are not, they are not like a limited company. They are just, a group of self-employed people coming together saying, let's run a business, let's work together, and let's run a business. So what it means is that the owners of the business are the same thing as the business. So the business assets are jointly owned by all the owners of that business. And all of them are jointly responsible for every liability, including loans and mortgages that are taken out in the name of that business. So in the event of default, every single one of them is responsible severally and jointly for that particular loan or anything. So even if your share of the business is just 30%, and then as a business partnership, you guys decided maybe there are two of you, and you own 30% share, and this person own 70% share, and then you borrow say £250,000, as a mortgage secured against the business property or by the business. If there's a default and that money has to be repaid, the both of you are individually and jointly responsible for the total loan of £250,000. The lender does not care who owns 30% and who owns 70%. So the liabilities there are jointly owned as well as the assets. But when it comes to profit sharing, you can share your profit according to your shareholding capacity. But when it comes to liabilities, right, everybody is jointly and severally responsible for those liabilities and for those loans. So if the criteria for regulated mortgages, we have talked about regulated mortgages now. So if that borrowing is happening and the property in question meets the criteria of regulated mortgages, then that applies as a regulated mortgage. Let me give you an example. If there are two of you in a partnership and one of you decides to take a loan, and one of you decides to take a loan to invest in the business, and that loan is secured against the property. If that property passes the criteria of a regulated mortgage, it becomes a regulated mortgage, right? The property it is secured against becomes a regulated mortgage. But if that property does not pass that criteria, then it is not a regulated mortgage. So what the lender does is the lender will insist that there will be a written agreement, and that written agreement should specify who has power to negotiate a loan and on what basis the contract will be signed. Can one person sign on behalf of others, or can the company even borrow? Does the company have the power to borrow? That written agreement should specify those things. The essence of that is to make sure that the lender can safely lend money to the business. So if that written agreement is not there, forget it. So you don't just come together and verbally agree on something and start doing it, and then you walk into a bank and say you want to borrow money and secure it against a business premise. No. Or you want to borrow money and secure it against your property for a partnership business. There has to be some kind of written agreement. Now that partnership agreement should contain things like each partner's share of profit, like I've mentioned, 30-70. What share of profit do you have? 30% or 70%. Your share of profits, funny enough, can go a long way to also determine what you can borrow individually on your own as as a shareholder in that business, as a partner. So if the lender has to assess your income, will assess your income based on your share of profits in that business. So if you want to borrow against your income from that business, it has to be based on the share of profit you have in that business. If you have 30% share of profit in that business, it means that the income of that business, 30% of it is what the lender is going to use to adjudge how much they can lend to you based on what you're earning from the business. The agreement has to carry something like the arrangements that is in place if one partner dies or retires or becomes bankrupt. These things will be specified in the agreement. The agreement will also contain things like the ability of the partnership to borrow, and if so, how many signatories do they need for that partnership to borrow? Do they need one who can sign for everybody, or does everybody involved in the partnership need to sign? So that's for business partnership. Now, what about limited liability partnerships, LLPs? Now, LLPs are different from business partnerships because of the way they are structured. Now, LLPs operate like a limited company. Okay, it's a form of partnership, but the business in this case is separate from the owners. So partners coming together, but they set up a company which is a limited company. So it is called a limited liability partnership. So that business is separate from its owners, is separate from the partners, is a separate entity from the partners. So the partners only act as agents of the partnership. So what it means is that just like it happens in limited companies, the liabilities of those partners are only limited to the capital that they brought into the business. So if the business is owing money and anything happens and the business is going to be liquidated, the partners can only lose as much capital as they have invested in the business. Their personal assets, like their personal properties or whatever belongs to them personally in their personal name, cannot be touched. So if the partnership borrows money in the name of the business, it is the business that is owing the money, not the partners, because the partners are just acting like agents on behalf of the partnership. So if there is a case of default and there is need to take action, the action will be taken against the company, and it is the company who's going to pay the debt. The partners' personal and private assets are protected. So their liabilities to the debts of the company is not beyond it does not go beyond their contributions to the capital composition of the company. So in that instance, when they take out mortgages, the loan is advanced to the LLP itself, not to its partners. Okay, so it is the LLP that is the borrower. On the mortgage deed, the name that will appear on the mortgage deed, the name of the limited liability partnership, the LLP, not the name of the partners. Okay, the lender, however, may decide to take personal guarantees from the from the partners, if they want to, just like they would do in a normal limited company business, right? Personal guarantees are simply a way of committing the partners to say, hey, we know that the company is the one owing this money, but we need you to personally guarantee this loan, in the sense that if the company doesn't pay, you will pay. Yeah, so if the company doesn't pay, we can come after you and your assets. That's a personal guarantee. A lot of lenders do it these days. If a limited company is coming to borrow money, maybe as a mortgage or even as a business loan, they will require a personal guarantee. Because as far as they are concerned, if you cannot personally guarantee that loan, it means you're not very confident of that loan being repaid. A lot of business owners excuse me, a lot of business owners do not subscribe to that. They don't want that personal guarantee. They don't like it. They'll just say, I don't want to personally guarantee this loan. If you cannot lend me this loan without personal guarantees, then I'm not taking it, because they want to protect their personal assets. Some business owners will say, I don't have a problem because I'm confident that this will be repaid and I'm confident in the purpose for which you are borrowing it. And really, it really depends on how badly you need that loan, to be honest with you. If you're in a situation where that loan is a case of life and death for your business, you wouldn't mind signing that personal guarantee and just getting the loan. But that's one way the lenders protect themselves. However, there are lenders out there who don't take personal guarantees. They just lend you the money, no personal guarantees. It's lent to the business, and that's their risk. They might, however, decide to take a floating debenture on the business. That floating debenture is a letter to your bank saying that, hey, this company is owing us, just in case the company is about to be liquidated. The assets of the company should be, we should be paid from the assets of the company, which is part of the cash in the bank. So it's a floating debenture. It's not like taking charge on any of your assets, but just to let your bank know that, look, we are interested parties in this business because they are owing us. So mortgage lending to LLPs is unregulated because it does not meet the definition of a regulated mortgage. So if the mortgage is, if the LLP is taking out a mortgage to buy their own business premises, it's an unregulated mortgage because it's not secured against the partner's private residence. It's secured against a commercial property. And then it's a business decision, and the borrower in this case is the business and not the individual. Okay? Thank you very much, folks. And we're going to pack it up here. And next week, we're going to continue discussing business borrowers. And trust me, next week, you wouldn't want to miss it because we're going to be talking about special purpose vehicles, SPVs. A lot of people have heard about SPVs and how they operate. And next week, we're going to come to you and tell you exactly how SPVs operate, how they are useful, why they are useful, and why a lot of people are using SPVs now to arrange borrowing for their property investments. So keep tabs with us, and God bless you. Take care of yourself, stay safe, and have a lovely, lovely day. Goodbye, and God bless.